In this exercise, we'll be doing problem 16-1A that you can find in your textbook on page 766. We are going to do a full statement of cash flows using the indirect method. The information that's given to us at first is a comparative balance sheet from December 31st, 2013 and December 31st, 2014. At the bottom, they give us some additional information. They tell us the investments were sold for $210,000 cash, that equipment and land were acquired for cash, that there were no disposals of equipment during the year, the common stock was issued for cash, there was a $190,280 credit to retained earnings for net income, and that there was a $72,000 debit to retained earnings for cash dividends declared. And again, we're putting together a full statement of cash flow using the indirect method. So we set up our financial statement like we do with all of our others. We start with a heading, identifying what statement we're looking at, and it's for the year ended December 31st, 2014. We start with the operating activity section, and we know that to start off our operating activity section, we start with our net income. In the additional information given to us in the problem, in letter E, it tells us that there was a $190,280 credit to retained earnings for net income. We know the retained earnings account is an equity account. Therefore, if it's being credited, we know that it was an income amount of $190,280. We now need to come up with the adjustments to reconcile our net income to net cash flow from operating activities. This is where we need to look for income statement items that we need to adjust net income for. Those income statement items would include expenses that have no cash impact and gains or losses from the sale or disposal of non-current assets. They tell us in the additional information in letter C that there were no disposals of equipment during the year. That indicates to us that we can go to our comparative balance sheet and compare the accumulated depreciation from last year with the accumulated depreciation from this year in order to determine the depreciation expense that was recorded on the income statement. Remember, depreciation has no cash impact. Our journal entry for depreciation is a debit to depreciation expense and a credit to accumulated depreciation. They tell us that this year there was $124,800 in accumulated depreciation, and last year there was $111,000 in accumulated depreciation. Therefore, there was an increase of $13,800, which represents the depreciation expense that was recorded on the income statement. Remember, we're adding back in the depreciation expense because there was no cash effect. We then notice that in part A of the additional information, that it tells us that investments were sold for $210,000 cash. We now need to go to our comparative balance sheet and see what the cost of those investments were. So you can see that on December 31st, 2013, our investments had a value of $180,000. That represents what we as the company paid for those investments. However, we sold, as you can tell, there's a zero balance in the investment account on December 31st, 2014. So we sold all of those investments for $210,000 cash, which means then we would have had a gain on the sale of our investments. In order to calculate the gain, we look at the difference between how much we sold the investments for minus how much we had paid for those investments. So we would have had a $30,000 gain. Notice that we are subtracting this number. We want to reverse the effect of that gain on net income. Gains increase net income, so we want to back out that $30,000. Investments are our non-current assets. Therefore, the sale of those investments will be handled in our investing section of our statement of cash flow. We can now move on to the changes in our current operating assets and liabilities. Remember, we do not compare the change of cash at this point in time. So we'll start with our accounts receivable. It tells us that last year it was $156,720, and this year it's $170,880. So we have an increase in accounts receivable. Remember, we need to figure out what that increase does to our cash. The more sales we do on account, the less cash we are collecting. Therefore, an increase in accounts receivable has a negative impact on our cash flow. So we'll take our prior year balance of $156,720 and subtract away our current balance of $170,880. So our increase in accounts receivable from last year to this year has a negative impact on our cash flow of $14,160. The next one is our inventory. Last year, it was $462,840. This year is $481,320. So we also have an increase in inventories. Again, an increase in inventory has a decrease effect on our cash flow. We're purchasing more inventory, but not selling it quickly enough. So we take our prior year balance and subtract away our current period balance. It's having a negative impact on our cash flow of $18,480. Investments, land, and equipment are all considered non-current assets, and any changes in those accounts will be handled in our investing section. So we go to our accounts payable. Last year, $303,720 versus this year of $318,360. So we have an increase in accounts payable. When our liabilities increase, our cash flow increases. Again, when we purchase items on account, we're not actually spending any cash. We're holding on to our cash amount. So we'll take our current period, $318,360, and subtract away our prior period amount. So we have a positive impact on our cash flow. We also had accrued expenses. Last year was $39,480, and this year it's $31,680. So we actually have a decrease in our accrued expenses payable. The only way that our liabilities go down is when we pay for them. So when our liabilities drop, so do our cash value. So if we take a look at what we had we had $39,480. So we will take our current period of $31,680 and subtract away the prior period amount to get how much has an impact on our cash flow from the decrease in our accrued expenses payable. We also have dividends payable. However, remember, we pay dividends to stockholders. So when we're dealing with any account that deals with stockholders, that's a financing activity. So we will add all of these pieces together to arrive at our net cash flow from operating activities.